Welcome to the Daily Update, where I'll go over the action in the market for Friday, May 5th, and then we'll see how things look for Monday, May 8th. You can probably detect a change in my voice. I seem to have picked up a little bug as I'm going around Warsaw, Poland, but hopefully I'll be able to get through this just fine. We had a pretty significant up day. The market liked the employment situation report. There were earnings reports that came out. We had gone down and hit support on Thursday. We were able to bounce up off of that, but we're still pretty much mixed overall with how things are looking. There are some positive things. There are some negative things. Some of our charts are pointing higher. Some of them are pointing lower. We're also seeing a lot of negative divergences right now. So the market is kind of right in between what it wants to do. Before I get into the video from May 6th, which is today, through May 14th, I'm still traveling. I'm doing the best that I can with trying to post something every day. The current situation that I'm in right now doesn't really lend itself well to recording a video unless everybody leaves. Well, that's what's happened right now. And while they're gone, I can quickly try to put together a video. I don't have the privacy that I usually have when I'm recording the videos every day, but I'll keep trying to do the best job that I can with that. I do have a podcast that I have launched now on YouTube. I'm rethinking that of maybe making a separate podcast that's different from the video that you're watching. In either the podcast or the video, there will be a PDF of all the slides and charts. Just click in the description to be able to download that and follow along. I do have a private Facebook group that you're welcome to join if you would like to. And then any other platforms. I haven't really had much feedback on this, so I'm just kind of sticking with what I'm doing right now. But if there are other social media platforms out there that you would like me to post things to, please feel free to let me know about that. And I don't have a poll for this week. Trying to put together the videos and the organization and being out of sorts with how I do things, it's made it all kind of confusing. I know the poll's not that big of a deal. I've decided to let it slide for right now until I return from this trip. All right, let's go back and talk about what happened. At the open, we had a gap higher open. This was the market reacting to the employment situation report. The futures were quite strong even before the report came out, and that just carried over into the session. We opened above R1 at 40.80. We also went up above R2 at 40.98. As the day went on, we drifted a little bit sideways. It looked like, okay, are we going to start to fall back? Well, no. We actually started to go higher, and we went above R3 at 41.33. Then prices retreated from that level, and then we closed slightly above R3 for the day. So we were able to get back above the 4100 level. We were up 1.85% on below average volume. It was just about average, but it was still a little bit low. That is something to still be concerned about. The technicals, as I said, are pretty much mixed right now, and I have all the charts to show you to kind of back that up. Inflation and interest rates are really the fixation of the markets right now. On a company-by-company basis, it'll be the earnings reports as they're released, any other Fed speak that we may get, and then any other banking information that we may get. What are some comments that we can make? The employment situation report as well as earnings reports were taken as positive. The dollar was down and interest rates were up. The dollar declining gave some support to stocks where interest rates going up could have given some headwinds. The 10 to the 5 and the 30 to the 5 have gone back to being normal now. The 10 to the 2 and the 10 to the 3-month yield curves remain inverted. In my opinion, those are the most important ones. First, we have the 10 to the 2, then we have the 10 to the 3-month. That's what a lot of economists use to measure, are we going to head into a recession? Sentiment is positive. It went back up with the up day where we closed at 59, where we had been at 52. Our trend is positive. The green line's crossed back above the red one, so it's strengthening, and that green line is going up. But when you look at the ADX, it is weakening. It's below its moving average and declining. Both of them are below 20. Our bias is positive with the update, but I've kept our momentum at mixed. We've just been bouncing all over the place without a lot of conviction. The economic reports that came out, the big one of the month is the employment situation report. The non-farm payrolls came in at 253,000, much more than the 180,000 that they had expected. Last month it came in at a revised 165,000. And then the non-farm private payrolls came in at 230,000, much greater than the 160,000 that had been expected. Last time it came in at 123,000. The unemployment rate came in at 3.4%. They expected it to be at 3.6%. Last time it came in at 3.5%, so it actually ticked down a bit. The average work week was unchanged at 34.4 hours. They expected it to come in at 34.5, a little bit less than expected. The average hourly earnings came in up 0.5%, greater than the 0.3% that they had expected. Last time it came in at 0.3%. Some other economic things to look at. On Thursday, we had the weekly jobless claims. They're starting to turn back up. What we're really watching here is this blue line to see what is the overall trend, and the claims are starting to tick up. They're above 200,000 and starting to advance. The continuing claims, how long are people on unemployment claims? That's continuing to go up even though it fell over the last week. Here's a look inside of the employment situation report. Way over on the right-hand side, this is the number of jobs that were created overall. Also, here's the employment monthly chart, just showing how it continues to go up. What we're waiting for is this is one of the key measures that the NBER, they're the people that officially declare whether or not we're in a recession. They're not going to declare a recession until they see this line starting to come down. Then down below, I have a rate of change going back from year over year to see how it is declining overall, but we're still positive when we go back month to month. The unemployment rate continues to be very low. If we're going to head into a recession, at some point, this is really going to turn and start to go up, but it has not done that yet. FactSet, as far as earnings are concerned, just with an update as of Friday, they say that the number of companies that are reporting positive earnings surprises and the magnitude of these earnings surprises is above their 10-day average. And I've mentioned this in other videos. This is one of the posturing things that goes on. If the analysts lower the estimates and then the company comes out and beats that, everybody's happy and it's time to party. Well, it's a little bit of manipulation going on here. Then on the last part of this first paragraph, it says, however, the index is still reporting a year-over-year decline in earnings for the second straight quarter. At this point, 85% of the companies in the S&P 500 have reported their results. Now, getting into our charts, looking at the intraday, here is how we gapped higher right at the open, above R1, above R2. Eventually, we made it all the way up to R3, went above that, stalled out just under the 4150 area before seeing a little bit of selling going into the close. We ended up closing just a little bit above R3. Here's the 10-minute intraday chart of the SPY. We had been going positive in the overnight session, and then in the pre-market session, prices continued to go back up. We took on that positive stance right after the market opened and went higher, saw a little bit of a fallback, but then late day strength, and then a little bit of selling going into the close, and we were pretty much flat in the initial overnight session that now will stay closed until Sunday afternoon or evening, depending on your time zone. Large cap growth had a good day. It really outperformed large cap value. Here are the closing values, where growth was up 2.1% versus 1.54% for value. But it underperformed with the mid caps and also underperformed slightly with the small caps. This is what we're seeing in the market right now. It's the really big companies that are doing well, where the mid to small companies and even other companies in the S&P 500, they're not performing as well as especially companies like Amazon are right now. On a one-day basis, we might have overdone it. When we look at our advanced decline line percent, we were above 80%. Sometimes that means short-term exhaustion. Doesn't mean we'll turn and go down. It just means that things might slow down in Monday's session. Here's also the advanced decline ratio, also looking rather extreme. May mean that we slow down in Monday's session. Looking at sentiment, the Ultra Index is starting to go back up, but we're still below this moving average. The VIX declined with the update, both on the line chart and on the bar chart, and we're well below 20 now, showing a lot of complacency in the market. Here's the VIX of the VIX, which had spiked up on Thursday. It came back down with the update, both with the bar chart and the line chart. The equity put-call ratio has not generated a new signal yet, but it has been rising slightly. In a good market where we're going up, we would want to see this equity put-call ratio going down. It's actually been going back up. Then the MOVE index is on the top, where we came down a little bit with volatility. The VIX is on the bottom, which measures stocks, and the correlation between the two remains very high. The SKU index, which the VIX measures at the money options, the SKU index measures out of the money options, above and below current price. We're just about at the midpoint now. We're not in the red area or down in the blue area. Fear ticked up just a little bit over the last few days with this particular fear gauge, and it also ticked up slightly with the other fear gauge that we look at. We also had the latest reading of the American Association of Individual Investors. They had become more pessimistic lately, giving almost an extreme negative reading. This red line is the moving average, showing how we're coming up out of being very pessimistic, and it's at those points where we use this as a contrarian indicator. Folks are still tending to favor a risk-off posture, meaning that they're getting into bonds instead of getting into stocks. Some advanced decline line studies. You can see based on price, we really shot up. Volume also had a good day. We shot a little bit higher based on price, but we haven't really broken out. This is looking better when you look at price. We're still seeing a bit of a negative divergence based on volume. We have not recaptured this moving average. New highs, new lows. With a big up day, we saw new highs really contract. Our 5 period continues to decline, and our 10 period is also declining. The advanced decline ratio climbed back above 0, so that's turning slightly positive. Accumulation distribution, we came down to the moving average and turned back up. That's slightly positive. Then looking at the cumulative advanced decline line of the NYSE, where we had been coming back up with the S&P, we did not match that high with the cumulative advanced decline line, nor with the regular advanced decline line. That's another negative divergence that we're keeping an eye on. Looking at the S&P on the top and the NYSE advanced decline line on the bottom, we're still making a series of higher lows. That's positive. Looking at just common stock, we're also seeing a negative divergence. We made a higher high based on the advanced decline line. We made a lower low based on the advanced decline volume. Looking at a broad range, we're coming back up to the moving average with the NYSE advanced decline line, turning back up with the S&P advanced decline line, coming back above the moving average with the mid caps. We're turning up, but we're still below a declining moving average with the small caps. Looking at our trend, we're switching back and forth. No matter if we have an up day, then we go positive, a down day, we go negative. The green line crossed back above the red line, so we default to positive. If you're really aggressive, that might be a buy signal for you. However, with the ADX, we're below the moving average and declining, and both the moving average and ADX are below 20, suggesting that we are in a choppy sideways environment. Looking at volume, it had been picking up nicely, but to have a solid up day with the employment situation report coming out, and then to see volume drop below average, that's a bit of a concern. In the short term, here's the daily chart where we came down to this previous resistance level, which once we broke above it, it became support, and we were able to get back above this pivot level. On the bottom, you can see where we're just slightly at the moving average as far as volume is concerned. Another positive sign on this chart is we're still above the 50-period moving average. We were able to regain both 20-period moving averages, so in the short term, that switched things back more to positive. The stochastic study, in the short term, we're just bouncing all around, depending whether it's an up day or a down day. We're more at the midpoint in the short term. Intermediate term, we're negative, but turning back up. Long term, we're just coming down after being extreme positive. The force index has gone slightly above 0 again, so that's somewhat positive. Intermediate term, the balance of power, we're below the dashed line, but we turned back up, so that's negative, but looking a little bit better. As far as our double and triple exponential moving averages, we're coming right back up to both the red line and the blue line, so that's positive. And then longer term, we lost support below the anchored moving average going back to the all-time high, but we recaptured that, so that's turning back a little more positive. The go-no-go system remains neutral with the pale-colored blue bars. The TTM squeeze looking more negative. We're dropping below zero and we're starting to see red bars where we had seen blue bars before. Here's a longer term look at that. We had gotten to a pretty extreme positive reading and now we're coming down off of that and then starting to turn negative. We're back a little bit above the midpoint with our standard deviation study. We're right now at the +1 stage as we're bouncing around. The Bollinger Bands also are slightly above the midpoint, so that's more of a positive slant. We're above all the moving averages with our intermediate term rainbow, so these may provide support if we see some weakness. The Arun, after giving us an extreme positive reading, has been coming down. Buyers are starting to decrease where sellers are negative and going flat right now, so this maintains a positive stance. The PPO study is still positive in the long term, intermediate term, and we're coming back down with the short term, and we're in danger of actually dropping below the zero line. Looking at the McClellan oscillator, we're also seeing a negative divergence where the S&P was going up, but the McClellan oscillator was making a series of lower highs. In our broader range, we're seeing the same thing. The S&P was going up, but the McClellan oscillator was not matching that. The Swindler Trading Oscillator, this is a warning sign. We turn down based on price and volume on an up day. The PMO study, negative overall. We're negative based on price and volume. The Elder Impulse system has switched back to positive for the S&P. The Parabolic SAR is still negative with the dots on top. The PMO study, we're seeing some negative divergences here. The S&P was rising, but the PMOs were not. We're still going down with the buy signals, and we're rolling over with the PMOs that are above zero. All of our oscillators are more negative now. Short term with the slope and the TSI, they're negative. The MACD, the PMO, the PPO are also below their moving averages. Our longer term oscillators with the TRIX and the KST have also turned negative. We're still above the 50-period moving averages, both the simple and exponential moving averages. If we start to fall, we'll be watching that as a level of support, especially the red line, which is at 40.42. That's the simple moving average. Here's our moving average tree showing how we were able to recapture the 20-period moving averages. The BPI on an up day continues to decline. However, it's still above 50. We're also seeing some negative divergences. The NYSE BPI is also continuing to decline. It's below 50. It ticked up a little bit on Friday, but with the up day, you would expect this to turn up stronger than it did, and it just didn't do that. It just means the big companies are really controlling the market right now. The Chaikin money flow is still positive, but showing weakness. The Chaikin oscillator is below the dashed line, but it did turn back up, but this is still negative. The money flow is also below 50, even though it ticked up. That's negative. The vortex, the red line is on top, even though it's declining. That is negative. The ultimate oscillator, this is positive. We're above 50 and advancing. On balance volume, we dropped below the moving average, so that is more negative. And here's another place where we're seeing some divergences. The S&P was going up. The percent of stocks inside the S&P 500 above their 200-day moving average, that's not breaking out, nor is it breaking out with those that are above their 50-period moving average. Here's another look at that same study. I don't know which one is easier to understand or if I need to change it even more, but this is also showing some negative divergences that we're seeing. The summation index based on price and volume continued to decline, and we've dropped below zero based on volume. Relative strength, we're above 50 with the 14 as well as the 9 period, not giving us an extreme reading currently. Looking at some Fibonacci studies, this is a new chart. I posted this in the Facebook group and on the community tab, and I have to thank the Game of Trades for this. I watched the video that they put out a few days ago, and I thought, okay, this is kind of interesting. This is a step process to try to get a handle on where is resistance. What you do, step number one, a trend line is drawn between two major lows. This was in June of 2022 and October of 22, and you draw this line here. Then using a drawing tool, you make an exact parallel and you go back to the all-time high. As we're following price along here, are we going to go up to this level, which is at about 4,200 right now? If we go up to that point, are we going to be able to break through, which would turn things a lot more positive? Or are we going to come up to this level, turn, and then start to go back down? Also, the quadrant lines show that we just really had a hard time breaking through this upper resistance level, and we have not broken through it yet. Short term, we're back above the 100% retracement at 4,123. We closed at 4,136. Longer term, we're coming back up to the 50% retracement. Can we get above 41.56? If we start to fall, we're looking at support at the 4,000 level. Longer term, we also have more support at 40.20 if we fall. Then here's the 20-period moving average of open, high, low, and close. Sometimes these provide support or resistance. We've just been slicing through them. We came almost back up to the high point for the moving average there, which may be acting as overhead resistance. Our different charts. The Heiken Ashi has now an open candle. That's positive. The Kegi chart is negative with a red line, but it's pointing up, so it has a positive bias. The Renko is still positive. The three-line break is still positive. Looking at some other indexes, we have the S&P on top where we were able to break back above this blue line. We are just barely above it when we're comparing it to the NASDAQ. We closed just slightly above that. We've been having a really difficult time with the NASDAQ at this level. Can it break through and keep going? The equal weight index continues to underperform the S&P 500. The transports continue to underperform the Dow. Dow was able to get back above its 50-period moving average above this S level, but we have a pivot level above current price. On the positive side, we're above the 50 and 200-day moving averages. The diamonds have switched back to positive. The NASDAQ, which now could be seen as making a quadruple top, just is having a hard time breaking out. NASDAQ 100 also showing a little bit more strength, but not really breaking out. The Qs have switched back to positive, and we're above this 38.2% retracement level with the NASDAQ 100. If we fall, will that level hold? Then looking at the Qs, we've been able to recapture this anchored moving average going back to the all-time high, so that is more positive. The small caps are still having a lot of trouble, even though they were up over 2%. They have not been able to regain the pivot level. We've seen a recent death cross with the moving averages, and there's a lot of overhead resistance. The Russell is still at about 50 with the RSI, even though it's showing some improvement. And the MACD is still negative, but trying to turn up higher. The small caps continue to underperform the S&P 500, but the Elder Impulse system has the small caps turning back to positive. The mid caps are still having a hard time getting back above their 200-day moving average, which is also at about this pivot level, and we could be getting ready to see a death cross. The mid caps have switched back to neutral after having been negative. The micro caps, after dropping slightly below 100, were able to recapture that and be up 2.5% on Friday. We did not set a new 52-week low. The home builders, we're going sideways with the S&P. The home builders have been chopping a little bit. The ratio is still hanging in there pretty strong, and they're still having a pretty strong tendency to go in the same direction. So we're not really getting an awful lot from this chart right now. Looking at the banks, I don't actually have any bank stocks to show you. The first thing is the financial sector, where we're coming off of a recent death cross. The financials compared to the S&P, even though they bounced up a bit on Friday, are still showing a lot of weakness. And the regional banking ETF is really underperforming the financial sector, and the financial sector is even having a lot of problems. So even though we bounced up with this ratio on Friday, there's still an awful lot of weakness. We're looking at the S&P and the TLT, which is the long-term bond ETF. Over the long period of time, they have a strong correlated relationship, but lately they've been having more of a tendency to go in opposite directions. The spread between the two is starting to get larger again. Then looking at bond yields, they were up in Friday's session and bond prices were down. Our long-term trend analysis, we're still watching this special K. We're coming back down below the moving average slightly. We really want this to turn and go back above this red line if we're going to switch to a longer-term positive environment, and that just has not happened yet. We're still above all the plotted moving averages with the long-term moving average rainbow. And then our long-term trend analysis, the MACD is still above zero and advancing, and it's still above the moving average, suggesting that this breakout above the trend line is legitimate. If we start to see some weakness, we'll be really watching this chart, but so far it has been holding up. Looking at the updates of our possible positive scenarios, the Qs to the S&P had a pretty good day. We're pretty much flat with discretionary, showing a little bit of improvement with large cap growth versus large cap value. With our growth value ratios, the large caps are looking better, a little bit of an improvement with the mid caps, and not really improving that much with the small caps. The S&P continues to underperform utilities. As I say in every video, it seems like in a really strong environment, we want to see this ratio really going up, and it's actually been chopping sideways to declining. This is another warning sign. When we look at the Amex, NASDAQ, and NYSE, and then take a 5-period moving average of their highs minus their lows, we continue to be below zero. Another sign that we're maybe getting exhausted here, we had come above the 90 level with the 10-day average of the highs minus the lows for the S&P, stayed up here for a few days, but now we're starting to drop back down. Longer term, we're still hanging in there positive with our 50-day exponential moving average of the new highs minus the new lows. The red line is still above zero, and it turned down slightly, but it's still positive. And our indicator itself is giving us a rating of 7, so that is positive. Our NYSE breadth thrust, that was a trigger signal back in October. That's still on the books. And a more recent signal was the ZWAG NYSE breadth thrust. That is still on the books as well, even though we're seeing some recent weakness. Another warning sign, we're still above zero based on price when we look at our 19-day exponential moving average of the advanced decline ratio, but we've dropped below zero based on volume. The 2-year Treasury yield, after spiking up and coming back down, is that going to continue to give some support to stocks? If we see this rate continue to fall and the S&P going up, this ratio will continue to go down. Then there are staples. I'm still wondering if we're setting a new spike right now. It took out these other spikes from a few days ago, and we're not really sure what's happening with this ratio currently. So what's our outlook for Monday? We're still in the middle of earnings season. Our technicals are really mixed overall right now. We have wholesale inventories coming out on Monday, the whole list of geopolitical events. It's going to be driven by earnings as well as any Fed speak or anything to do with inflation or interest rates. And then there's a little bit more talk about this debt ceiling issue that's been going on. If that continues to go on and is more of a political posture situation, then that may end up having some impact on the markets. And then are we going to get any more banking information? Looking at the Stock Traders Almanac for May, this begins the worst 6 months of the year. Then we project ahead from May 15th through the 19th for options expiration. We're up 45% of the time and down 55% of the time. The week after options expiration, we're up 64% of the time, down 36% of the time. Going back the last 20 years, on May 8th, we're up 66.7% of the time with the Dow. The S&P is a little more negative, slightly more positive at 52.4. The NASDAQ is looking more positive. It's up 71.4% of the time each May 8th. Over the last 72 years, we've been up 59.7% of the time in May and down 40.3% of the time. Then here are the yearly backdrop statistics that go all the way back to January and the Santa Claus rally and all of that. All of this is still positive and maintaining that positive backdrop that we've been working from. Then the next chart is showing how we go okay into the first part of May, but then we start to see some weakness during a pre-election year. This chart on the gray line also pretty much shows the same thing. And we're also starting to see some weakness coming out on this chart as well. The idea to sell in May and go away. That's the old adage that people do. So our scenarios can't really go with the down one right now because our technicals are mixed, but there are a lot of negative divergences. Can't really go with the up one because we are mixed technically right now. So we continue to go with the sideways bias because the ADX is weakening since it's below its moving average. It's also below 20. But we default to the positive side because the green line crossed back over the red line and the green line is advancing. So our warning signs, there are numerous negative divergences that are starting to combine with each other. Volume did decrease on an up day. The VIX is still showing a lot of complacency or a lack of fear. The STO, the Swindler Trading Oscillator, declined on an up day. The S&P is underperforming utilities. We're in a risk-off posture. The small caps continue to underperform, and the NASDAQ may be declining from a quadruple top. We just are having a really hard time with the NASDAQ of breaking through that resistance. And then earnings season, which could be either positive or negative. On the positive side, our longer-term positive seasonality and setups, those are still in place. We just need the market to start to cooperate with what has historically been happening. If we do start to fall, there may be some support levels at lower prices. So our conclusion, the S&P is mixed. It's not trending, and it's showing a lot of negative divergences. In the short term, it's mixed, and you could make a case for either side, as well as for the intermediate term. Long term, we're still positive as long as we're above the 200-day simple moving average. So thank you. I hope you found this helpful. I hope you have a really nice weekend. I will prepare the next video just as soon as I'm able to. If you want, please check out the Facebook group where I post things, as well as on the community tab. If I'm not able to do a video, I'll at least try to post something in either one of those areas. So have a great weekend, and I will talk to you in the next video.